Welcome to the Path to Homeownership by Sturgis Bank. Buying a home can seem like an overwhelming process. The goal of this presentation is to break down that process to help you feel more confident in your home buying journey. Every situation is different, so weighing the pros and cons to both buying and renting can help you evaluate on if it's your time to purchase your first home. Everyone is paying for the roof over their heads, so our goal would be to turn that payment to an investment for you. As a tenant, you're paying rent, and in return, you have somewhere to live for a month, and you're building equity for that landlord. Whereas being a homeowner, you're paying your mortgage each month, which allows you that place to live while also getting richer by building equity for yourself. Some difficulties or disadvantages that we'll want to consider for homeownership is typically it's going to require a larger down payment or out-of-pocket costs in the very beginning. You'll also want to keep in mind that property taxes and homeowners insurance are added costs on top of your regular mortgage payment. We can roll them into escrow, meaning we add those to your monthly mortgage payment, but those are also things that can increase over time. You're also going to be responsible for all the repairs, upkeep, and home improvements, meaning if that furnace goes out, that's going to be your responsibility. Now, some benefits or advantages to consider. It's a financial investment. You're building equity on something that we call an appreciating asset, which means over time, the value of that asset is more than likely to increase. There's tax benefits and write-offs, freedom to remodel and make the entire space your own without having permission from your landlord. And you're also moving towards financial freedom. That means once this house is paid off, you don't have any more payments other than your taxes and homeowners insurance. Just like we spoke about in the disadvantages, it is a huge financial commitment to purchase a home. Let's talk about some of those out-of-pocket costs to consider. First is your earnest money deposit. This is a deposit that you put down when signing the sales contract, stating that you're wanting to purchase the home. Next, you'll want to consider a down payment. For a first-time home buyer, we can go as little as 3% down on a conventional loan or 0% down on certain government loans, which we'll go over in a future slide. The next thing to consider are going to be your closing costs. These are fees that are accrued from the loan, from your lender, the title company, and other various places. It is possible to negotiate for the sellers to pay some of those closing costs, and those are something we call seller concessions. They are rare, but possible. And two other things you're going to want to consider are a home or a pest inspection. Those are not something that we necessarily require as a financial institution, but we do encourage so that you know what you're getting into, especially with some things that homes can accrue. We don't want you to purchase a home without knowing if maybe the furnace is going to break in the next month or so. So they can feel pricey in the moment, but definitely worth it in the long run. Now, along with all those upfront out-of-pocket costs in the beginning, you're also going to want to keep in mind some of the expenses that come monthly or over time when purchasing a home. Things like utilities, your electric, gas, maybe water, things like that are going to be monthly expenses that you'll want to consider, as well as maybe an emergency fund or larger updates or repairs that might happen in the future. Like I said, if that furnace goes out, that's on you. Now that you're ready to buy your first home, it's time to build your team. The first thing you'll want to do is find your lender to get pre-qualified. Some great qualities to look for in a lender is great communication and knowledge that they're willing and excited to share with you. After you've found your lender and got pre-qualified, let's find you a realtor. Find a local and trustworthy realtor that has your best interest in mind. They will help show you homes that fit within your budget, as well as take care of a lot of the paperwork to help us get to the closing. Now we're going to dive into the lending process and the requirements that come along with that. We have 5 stages of the mortgage process: pre-qualification, origination, processing, underwriting, and then finally we get to closing. Let's start with pre-qualification. This is where we take your application and some basic information to see how much you can afford to spend on a home. This will help guide you in shopping for that perfect dream home that's going to fit within your budget. Once you've made an offer on a home and that offer is accepted, that's when we go into origination. We gather that purchase contract and then we start moving forward. This is where you'll receive what we call initial disclosures and a loan estimate that gives you an estimated payment as well as estimated closing costs. Once those initial disclosures are signed, it's time to start processing. This is where we may have to pull another credit report, request any additional documentation, income documentation, bank statements, to make sure we match the loan application, as well as ordering your appraisal and title work. Once we receive all your documentation, appraisal, and title work, we send you into underwriting, where an underwriter will review the documentation and file information to ensure that we're meeting guidelines as well as staying compliant. The underwriter is who clears us to close. And once we receive that clear to close from the underwriters, we get to the closing table. We'll schedule closing, you'll sign a ton of documents, and hopefully receive your keys that day. Now let's talk about some credit score requirements. We don't specifically need a certain score, but we do look for certain things on your credit report itself. More specifically, we look for 3 traditional trade lines of credit, all with at least 12 months of payment history. This could mean credit cards, auto loans, personal loans, anything that reports monthly on your credit report. Now, if you don't have those 3 traditional lines, we can look at non-traditional lines of credit as well. This could be a cell phone bill, auto insurance, cable, utilities, even rent payments, as long as they have a 12-month payment history. Here's some tips to improve your credit score. Keep your credit card utilization under 30% if possible. So try to pay as much as possible each month. Keep unused cards open. Even if you don't use that card very often, closing accounts can reduce your total available credit, but it can also shorten the length of your credit history, which can negatively impact it. Try to be cautious of opening too many new accounts, as well as wait at least 6 months between credit inquiries if possible. Now let's talk about some of that documentation and information we're going to gather during your loan process. First thing we're going to get is your housing and work history. We need 2 years of history of where you've been living, even your landlord information and any addresses. We will also need 2 years of employment history, hopefully consistently in the same field. If not, there's always exceptions to every rule. So to break down that employment history, if you're a W-2 employee, we're going to require 2 years of your W-2s as well as 30 days of pay stubs. That may mean 2 pay stubs if you're paid biweekly or 4 pay stubs if you're paid weekly. Now, if you're self-employed, we're going to require 2 years of your self-employed tax documentation. That could be your personal tax returns and any business tax returns if you file them separately. Now, if your income comes from retirement or disability, we are going to require 2 years of your 1099s for retirement, pension, Social Security, as well as 60 to 90 days of bank statements showing those deposits. Documentation that we'll require from every borrower is proof of funds to close. This could mean a variety of different documents. Typically, we will ask for 60 days of checking or savings account statements, possibly any 401k or retirement statements, if your funds to close are coming from there. If you are receiving a monetary gift for your down payment or closing costs from a family member, we will need a letter stating that there is no repayment expected, but will also require bank statements from the gifter proving that they have the funds available. Now let's jump into some loan types. The first one we'll talk about is a conventional loan. Strong credit is usually required, but for first-time homebuyers, we have a minimum down payment of 3% options available. Next, we'll talk about our government-insured loans. FHA usually requires a down payment of about 3.5% or more, but will accept lower credit scores. VA are loans designed for military members and veterans. And then USDA RD, which stands for Rural Development, is designed for primary residences in specific rural areas. This option is a 0% down payment option. We also offer 15-year fixed rate mortgages. This is good for borrowers who want that consistent fixed rate mortgage, but also want to pay a higher payment so they can get that mortgage paid down faster. Our 30-year fixed rate mortgages is generally the most common. This is good for borrowers because you have that consistent monthly payment with that fixed rate, but it's a lower monthly payment compared to that fixed rate mortgage. We also offer what's called portfolio products. We utilize these products to tailor loans for unique situations. So if you don't fit into a normal bucket with the guidelines, then we can look at portfolio products to come up with a loan that's tailored for your unique situation. And last but not least, we offer construction loans. Construction loans can be used to build a house from the ground up or make substantial renovations to a house you already own. When it comes to the loan process, consistency is key. We want everything to remain the same as when you were pre-qualified. Here's a list of things to avoid before your home closing. It includes buying any expensive items, switching jobs, paying any bills late, changing any bank accounts. We really want everything to remain the same. So if you have any questions, if maybe you should or shouldn't do something, definitely ask your lender. Whether you're ready to jump into the process of buying a home or have any type of questions, we are here to help. We at Sturgis Bank look forward to working with you.